Thank you for joining us for our webinar today, Veterinary Practice Transitions from the Buyer's Perspective. Before we get started, I wanted to mention that there's a chat feature for this webinar, and you can ask your questions at any time during the presentation. The chat button is at the bottom of the PowerPoint as you hover over it. We will answer all the questions at the end of the webinar during the Q&A portion, but feel free to ask questions via chat as you think of them. Our presenters today are Matt Vanderloo and Laura Zock. Matt and Laura are CPAs and principals with SVA Veterinary Services. They specialize in providing vets the financial support they need to start, grow, and transition their practices. For vets looking to purchase a practice, Matt and Laura evaluate the various aspects of the practice, assist the potential owner with purchase price, cash flow, and tax considerations, and guide the buyer throughout the process. And with that, I will give it to Laura.
Great. Thank you, Jennifer, for the warm introduction on this cold day here in Madison, Wisconsin. Today we have a lot to cover, all relating to help out people that are considered buying a veterinarian practice. So today's agenda will be for us to discuss what the timing of buying a practice looks like, what factors you should consider, a few pointers on how to understand the value of the practices that you're considering purchasing, the tax considerations related to a purchase, a couple thoughts then too on employing the retiring veterinarian and what kind of due diligence is needed as part of this process. All right, we've got lots to cover, so we will jump right in with talking about the timing considerations. You might be wondering, is it time to buy? This really is a very personal decision, and you're going to want to ask yourself some questions as you think about this. Perhaps you're an associate and you're doing really well in the practice, you're operating at full efficiency, and you think it's time for you to take it to that next level. You're going to want to consider, are you ready to take on the business ownership and the management responsibilities that come along with it? And also, are you ready for the risk? With the risk, there's often great reward that can also happen. Like I said, it's a very personal decision and one you'll want to give a lot of consideration to. When you're looking at potential practices, you're going to want to think about the community you might want to be in. Is that going to be practicing in your hometown, or does it mean going to another area? Are you going to prefer a small town or an urban community? And then, do you plan on living in the community that you want to practice in, or will you commute from another town? You'll also want to consider the location of the practice. Not only whether it's convenient to you, but also is it convenient to the clients? Is it at a good location with good visibility? Also consider the demographics of the area. Is the community growing, or is it a stagnant area? And also along with this, what kind of competition exists? Is the practice the right size for how and when you want to practice? Then there's the asking price. Is it something you can afford? It will take some financially modeling with your consultants and your CPA to figure this out. And another thing you should consider, which often isn't thought about, is what is the philosophy of the current owner or veterinarian like in the practice? Is your philosophy similar, or does it differ? Upon a transition, do you expect the clients to embrace you or to seek out another option? That's why this is an important key consideration. Our ultimate recommendation here is for you early in the process to take some time to think about what your goals are and to develop your ultimate wish list. Then you can use that wish list when evaluating different practice opportunities. Chances are you'll evaluate a few different opportunities before you find the one that's just right for you. When you do decide that it's time for you to own your own practice, here are the general steps in buying a veterinarian practice. First, obviously, you will identify practices for sale. Where might you go to look for practices for sale? You might check out your WVMA postings or different publications. It might be through the professional organizations that you're involved in. And don't forget about the people that are in and out of your clinic every day or on a regular basis. The supply reps, your advisors, perhaps a practice broker. You might need to work with a practice broker to help you find and evaluate practices. When you do identify a practice that you're interested in exploring more, one of the first things you are probably going to do is be asked to sign a confidentiality agreement by the seller. This is an agreement that states that you are going to keep all the practice information, all the financial information, all the secret sauce confidential as you consider purchasing that practice. Sometimes this agreement is also referred to as a non-disclosure agreement. When you've gone through your due diligence, you're probably going to sign a letter of intent as well. This is a letter that indicates to the seller that you're interested in buying their practice. After the due diligence piece and you've decided that you want to make an offer on the practice, then it comes time for negotiations. Typically, it's the seller that places a price or a range of price on the practice, and then you're going to need to consider what kind of offering price you want to include. You'll also decide on tax considerations and what the payment terms might look like. These are all things that we'll cover in greater detail on the upcoming slides. And then is the happy day, the day that we pop the bottle of champagne, the day that you finally close on that practice and become its new owner. Keep in mind that you will want to put together a professional team to help you with these various steps along the way. And with that, when you start looking at opportunities, first you're going to actually give some thought to what it is you're actually purchasing. And the first piece of the practice that you're going to consider purchasing involves its tangible assets. These are the things that you can physically put your hands on. It's going to be items such as the accounts receivable. Hopefully the practice you're looking at doesn't have much accounts receivable. Most vet practices that we work with nowadays are collecting cash up front and have minimal accounts receivable. But you might want to consider purchasing the accounts receivable. If so, this price will be determined based on what amount the actual accounts receivable is at the date of the closing, perhaps with a discount for those patients whose accounts are maybe aged out and are maybe less likely to pay. Or you might decide that the accounts receivable is not something you're interested in purchasing and you would leave that with the seller. You're also going to be buying the existing supplies inventory of the practice. Here we need to think about how you put a value on that. It might mean having the supply rep come in and do a count of the inventory and give you an estimation. Or we might look through your financial statements and how much inventory is typically kept on hand and say maybe it's 1 month's worth of inventory or supplies expense, or maybe 2 months or something to that like. The main piece of what you're buying in a vet practice in terms of things you can put your hands on is going to be the equipment. This is going to be the waiting room furniture, the exam tables, your x-ray and ultrasound equipment, your surgical tools. And there's a couple different ways that you can put a price or a value on the equipment. It might be having an equipment rep coming in and giving an appraisal on the fair market value of the equipment. Alternately, it might be that we looked at your fixed asset or depreciation records and consider coming up with a value that way based on the number of years you expect to use the equipment. Also with the purchase is going to be the leasehold improvements of the practice. This would be the cost of the build out to make the blank white box into the veterinarian practice that it is. Last on here, I've listed the building. That's because you might be considering buying the building. It may or may not be for sale. If you do have the option to buy the building and are interested in buying the building, you're going to have a certified real estate appraiser put the price on that building. They're the ones that best know what's going on in the marketplace in terms of the real estate value. Matt, what other assets are involved with buying a practice?
So other than those hard, tangible assets, the things we can put our hands on in the practice, the other big asset, the big group of assets you're going to be looking at are the intangible assets in the practice. And there's lots of different names for these. It might be some people call it the goodwill, some people call it blue sky in the practice, some people call it the covenant not to compete. Any of those names works. You can call it whatever you want. The way I look at it is really the right to earn income off a block of patients in the future. So it's our ability to see those patients that were once with that practice and to have them be recurring patients in the practice. Laura had all the great strategies for how we can put a value on the tangible assets of a practice, and those are, in a relative sense, much easier to price and to figure out what the value on them is, and they're much easier to replace. If you want all of those tangible assets you need to start a new practice, you don't need to buy a practice. You can go out and get any of those. You can go to your supply rep and buy all the equipment you need, buy all the supplies you need. You can find a commercial real estate agent to get the space you need. It's really easy, in a relative sense, to get all that stuff. It's the intangible asset that can be of a lot of value and is very difficult to get, and the only way to get it is to buy an existing practice. So there's lots of different ways we can look at coming up with the value for that goodwill in the practice, but really it's a very fluid number because every practice is going to have a different value to different buyers. Everybody's going to look at the same practice a little bit differently, and it might be a better or worse fit for them, so they're going to be willing to pay a little bit more or a little bit less for that goodwill number. So the couple ways we can come up with that goodwill value or the value of the practice as a whole is we can go through the process of doing a formal valuation, whether that's a valuation report or a calculation report at the end. There's a very formalized process we can go through to put a value on the practice as a whole, and then also to give us a value of the intangible assets within the practice. There are also all sorts of great rules of thumb out there about what the price of a practice should be relative to the revenue that the practice is generating. There's a huge range here too. You know, depending on who you talk to, that rule of thumb is that the price of the practice is somewhere between 60% and 90% of the total revenue of the practice, which, depending on how much revenue we're talking about, that 60 to 90% can be a huge variation in actual dollars. Or we can base the price of the practice based on the seller's discretionary earnings, or SDE, in the practice. And really that's the revenue of the practice minus all of the operating expenses of the practice. Gets us to this SDE, and really that's before we consider any expenses to compensate the veterinarians working in the practice, whether that's salaries, wages, bonuses, employee benefits, and we use a multiple of that number, somewhere between 2 and 5. We multiply that number by something between 2 and 5 to get a value on the practice. And again, depending on that number, a range of 2 to 5 is a huge variation in actual dollars. So as we try and look at this in dollars, if we were to take what would be a fairly typical practice, especially if we look at national averages and national statistics for a practice, you know, at $650,000 of revenue, variable expenses, fixed expenses, staff expenses, facility expenses, to get us all the way down to $207,000 of net revenue in a practice. And again, that's before we consider the veterinarian's compensation in the practice. If we were to look at what that might look like in terms of a value of that practice, for the goodwill piece, you know, the typical range we're seeing on deals right now is somewhere between 75% and 130% of that net revenue before vet comp. So that put our goodwill number at somewhere between maybe $155,000 and $269,000. So a pretty significant range there on just a one vet practice. And then in terms of total price, you know, the rules of thumb might put us somewhere between 65 and 90% of that 1 year's revenue, which was $650,000. So a total price of somewhere between $423,000 and $585,000. So huge potential variation there, depending on which rule of thumb you want to use to try and value that practice. And a lot of that variation in practice price is going to relate to that big variation we see in goodwill. So goodwill and how you're going to value it really drives that price. And again, depending on who you are and where you are and what you're trying to accomplish, two different people are going to have two different numbers for that goodwill number, and are going to look at different things and put a different value on that practice. Laura, what are some of those factors we might want to consider when we're looking at a practice, and what's going to drive that goodwill up and down?
Well, there's a bunch of them, Matt. One of the biggest ones we see in driving whether the goodwill is on the higher side or the lower side of those very different ranges that you mentioned earlier is going to be the physical location of the practice. Really, you want a Walgreens type location. You want to be at that corner of happy and healthy that has a lot of visibility, a lot of traffic driving by it. Those tend to be some of the more successful practices, since your building and your location being right there can be advertising and marketing for you. Other things that the buyer is going to be thinking about when they consider, is the practice worth more to me or less to me, is going to be, is there a long-term lease, and are the lease terms favorable? Chances are that you, as the buyer, are going to be looking at taking over that lease or renegotiating that lease, so you're going to want to make sure that you're in the space and want to be in that space and that the terms are favorable. Or it might be that you, as the buyer, have the option to buy the real estate, and knowing that you can make that investment in that physical property, that might also be a reason that you're willing to pay more for that practice, is to have that opportunity to buy that real estate along with the actual client base of the practice. You're also going to want to consider the physical condition of the facility and the physical condition of the equipment. Older equipment or an older facility for you as a buyer means you might be faced early on in your, after you buy the practice, with additional expenses to upgrade the equipment, replace the equipment, maybe go from a paper-based record-keeping system to a technology or a computer-based system. So these are all things you're going to be thinking about when determining whether or not you're going to want to pay for goodwill a lower amount on that price scale Matt mentioned or a higher amount on that. There's a couple other things to consider too about goodwill that maybe don't necessarily have something to do with location, physical assets, etc. And that's going to be things like the vet tech utilization. Your techs are profit centers in your practice, and if you've got some great techs in there that are efficient, able to do a lot of services, that's going to free you up as the vet to do other things, and so the current structure of the vets and the vet techs and the utilization is actually something that you might be willing to pay more for. You're also going to want to look at the current fee schedule of the practice and compare it to market rates. There might be situations where the fee schedule of the practice is lower than the market rates. So from your buying perspective, you have the opportunity to potentially raise those fees to market rates and potentially improve the growth and the profitability of that practice. So here again is a point that might drive you to buy one practice or another, is what's their fee schedule like and what kind of opportunity does that mean for you. You're also going to want to look at the expense structure that the current vet owner has in place and consider whether you're going to be able to keep a similar percentage of your expenses as overhead, or perhaps you're able to make some changes within that overhead structure that might make that practice more profitable, and therefore that might be a practice that you're willing to pay a little more for based on that too. You're also going to want to consider, you as the new veterinarian owner, are you able to continue providing all the services that the current owner provides? And if you're able to provide more, that's another great way to boost the profitability and growth of that practice as well, so that might make it more valuable for you to purchase. One thing I do want to comment on really quick here for you to keep in mind as you're buying a practice is that the practice goodwill has different tax treatments from the owner's perspective or the seller's perspective, and it's a hot issue with the IRS right now. The issue is that if goodwill is considered a corporate asset, that ends up on a practice sale to be ordinary income for the seller, meaning more tax that seller is going to pay on the transaction. If it's considered an individual asset, that's actually capital gains treatment, which is a lower tax amount. The nitty-gritty and the details of this are beyond the scope of our presentation today, but I wanted to mention it because this will affect the seller's position on goodwill pricing, the amount that's classified as goodwill as you work through this transaction. And so you'll want to have the seller's motivation in mind when you are pricing out the practice and putting in an offer. Matt, let's continue putting some numbers out there to illustrate what this all might look like for a potential practice buyer.
Sure, so let's go back to that same solo vet practice. So we've got one vet in practice. Based on the national stats we're seeing, we're going to assume total collections in that practice, so total revenue of $650,000, and then net income, which is really net income before the vet gets compensated at all, at $207,000. So what we're seeing on a national level is a pretty typical vet practice. So let's assume then, as we work through this, that we've got on that practice, we put a total value of $500,000, and you can see on the slide here how we built that up between accounts receivable, supplies, equipment, and goodwill. And that would put us right kind of in smack in the middle of those ranges we talked about before. So in terms of price compared to total revenue, we're at about 77%, so right in that range of 65 to 90% we talked about. And then for goodwill, we're at goodwill of 97% when we compare that to the net income before vet comp of $205,000. So again, right in that range of 75 to 130% that we talked about. So we've got an example practice here. We think we know what it's worth. So the next big step as we work through this process of buying a practice, let's assume we've agreed to that price of $500,000 with the seller, so step one, price is set. In a lot of other big purchases, you might think that's kind of the end. We've agreed to a price, so now we're done. If you think about buying a house, we've agreed to the price, maybe there's some work to do around an inspection, but we're done. When we think of a practice, though, that's really just step one. We've agreed to the price. Now we've got to have some negotiations related to the allocation of that price, and then later on we're going to talk about once we have the price done and the tax allocation done, we got to think about payment terms. But for right now, let's just look at the tax allocation here. And this is where some fun negotiation really begins, and some really important negotiation as it relates to how the taxes are going to work out for both the buyer and the seller begin. So the key here to remember is that when we look at allocating the price, the buyer and the seller both have different goals in allocating whether either the purchase price or the sales price, depending on which side of the transaction you're on, to the different assets in that vet practice. And as is not going to be a big surprise here, the buyer and the seller with different goals are going to approach this differently and are going to want different treatment on all these assets. So as we look at allocating the purchase price, we've already broken it down into these different categories of accounts receivable and supplies and equipment and goodwill. The buyer, in general, is going to want to get tax deductions for the entire purchase price, and they're going to want to get those deductions as quickly as they can. So the buyer's going to want to allocate more dollars to accounts receivable and supplies and maybe a consulting agreement where they're going to get immediate tax deduction, less of those dollars towards equipment where it's going to take 3, 5, or 7 years to get the deduction depending on what kind of equipment it is, and then even less dollars to goodwill in the practice, because from a buyer's perspective, that goodwill is going to get written off over a 15-year period of time. The seller, however, is going to want to push everything they can towards items that they're going to get a better tax treatment on. So they're going to want things directed, that purchase price directed towards items that are going to get them long-term capital gain treatment, which is going to result in a lower tax rate eventually when they have to pay tax on the sales price. So the seller is going to want to allocate more dollars towards goodwill and less dollars towards accounts receivable, supplies, equipment, the consulting agreement, and get a better tax treatment, because ultimately for the seller, the better tax treatment is going to mean more of that purchase price in their pocket when the deal's all done and the taxes are reported and paid. So that's the motivation. What does it really mean in bottom line tax dollars, Laura?
Well, what it means for that potential seller is, they're going to have some substantial savings. Here's an extreme example that I put up there just to illustrate what this might actually look like. And what I have up here is first the seller wanting to have most of the purchase price of $500,000 allocated towards goodwill. So I use $388,000 in this example. You, from the buyer's perspective, as we mentioned, want as little allocated to goodwill as possible from your own perspective or your own desires and outcomes. So I use $50,000 in this example. So we've got $333,000 of a difference between what the seller is hoping is classified as goodwill versus what you as the buyer is hoping is classified as goodwill. Well, that amounts in potentially $50,000 of savings to the seller if they get their allocation, their desired allocation of goodwill, if they are at those highest income tax rates. So here again, we're explaining the motivation of the seller so that you as the buyer can know that going into this transaction and can, go into your negotiations having that in mind and work for something that you want. Oftentimes we see people negotiate on this and end up, giving or taking so that hopefully both parties can be happy with the allocations that they end up with. From your perspective on the buying side, this is important because of cash flow considerations. As Matt mentioned, the amount that you classify as goodwill, you are getting tax deductions for over 15 years. And oftentimes, your practice purchase loan is going to be over 7 years or potentially over 10 years. So you're paying off those loans faster than what you're getting the bulk of the tax deductions for in terms of timing. So this is an important consideration for you as a buyer because of cash flow considerations. Once you and the seller do agree to how you're going to allocate that price for tax purposes, you need to have it contained in writing. It's typically included in some of the final closing practice transition documents. And then both you and the seller must also complete a certain IRS form, Form 8594, and attach that to both of your tax returns. And this form then is telling the IRS that you and the seller have agreed to these allocations, and here are the allocations that you agreed upon. And now moving on to payment terms. This is one of the important considerations for you as a buyer as well. Typically, when you go to closing to buy that practice for $500,000 in our example, or whatever price you've agreed upon, the seller is going to expect you to be coming with cash. And most of us don't have pockets that deep, or a suitcase and an armored guard to go with us. Here's where it's going to be important to get your banker involved early on in the process of transitioning into ownership of a dental practice, because you're probably going to need to close with that $500,000 on that date for the practice to change hands to you. If you have purchased the accounts receivable, that might be something that you transact over the first 12 months as the monies come in the practice doors. There also might be situations where the seller is willing to finance part of the practice purchase price. From a tax perspective, the seller may want to spread their tax liability over a few years, and so here is where it might be an advantage to them to be involved with the financing of the practice. Oftentimes, if you're purchasing the building as well, we're seeing bank financing or a land contract as well. But ultimately, I think our lasting message here is be sure to get a bank involved early. You might need to check out a couple different rates or banks to get the best rates and the best deals on financing. All right, another thing you're going to want to have in the back of your mind early in the practice transition process, and then it will come more to the forefront as you work out the details of the transaction, is whether or not you are going to employ the seller beyond the terms, beyond the point at which you take over as the owner of the practice. The seller may desire to stay on, or they may not desire to stay on. But from your perspective, you're going to want to consider, if the seller does want to stay on within the practice, is whether there is enough practice profitability to both pay them wages for their work, and then also to pay you for your work, cover the overhead expenses, and have you be able to take home the money that you need for your own personal commitments, and also ultimately make enough money to pay off the loans that you took out to purchase the practice. Matt, what are your suggestions in terms of due diligence for the buyer? What does the buyer all have to look at here to get a good understanding about the practice and ultimately make that decision on whether or not they want to buy it?
Sure. There's, I think, potentially lots and lots of paper for the buyer to look through and to request from the seller to go through this process. Now, when you do the due diligence might vary a little bit on your familiarity with the practice and how quickly and easily things go through the purchase price negotiation, the tax allocation, the payment terms. You know, some of the information you might want to see before you even start the price negotiation piece to get a better idea of what's going on in the practice and get a better level of comfort with the practice. And you know, one of the typical things we see a lot of times is an associate who's worked in the practice buying it from the existing owner. If that's the case, you might not need to get as much information on the practice because you might already be pretty familiar with what's going on there. But at a minimum, you're definitely going to need to see financial statements and tax returns for the practice. You're probably going to want to look at a fee schedule for the practice, look at the lease agreement on the building so you know what you're getting into there, an equipment listing, some reports from the vet practice management software on revenue by source, whether that's by companion animal type or by services provided or both, to get a better idea of what all is going on in the practice right now and making sure that that's all things you're comfortable doing as the new owner. Maybe look at some charts of patients to see how they're being treated, what's going on, and maybe even looking at the employee files to get an idea of the new employees that you're going to be managing in the practice. So that's the big information request from the seller. Once the buyer and the seller have come to an agreement and we're pretty far down the road and pretty sure that we're going to have a transition in the practice, both the buyer and the seller have to give some thought to what's the plan to communicate to the patients and the clients in the practice that there's this transition coming up. I think as the buyer, you really want to be involved there and try and drive that process to make sure you can control how it's being communicated, when it's being communicated, and what specifically is being communicated to, and have a big part in crafting what's going on there. In addition, as the buyer, you're going to want to have some say in how you're being introduced to the patients. Is it just that letter that goes out that says there's a sale or a transition coming up, or do you want there to be some sort of overlap of schedules there for a couple weeks, a couple months, where you, as the buyer and the seller, see people together and you get to be personally introduced to them, or do you want some sort of an event, an open house or something like that to happen at the practice so that there's an opportunity for the existing owner to introduce you to a bunch of patients so that they can be comfortable and familiar with you going in. And then finally, there's got to be some work on post-ownership agreements, whether that's a covenant not to compete or some sort of consulting agreement. You know, as the new owner, if you're not familiar with, if you haven't owned a practice before, you might want the existing owner there available to help you manage the practice and help you get comfortable with that, or to fill in while you're gone and trying to take vacations. Or is it too big a practice for you to run on your own? Do you need some sort of an employment agreement with that exiting owner so that they stay on for some period of time to help you manage the patient load that's there in that practice? So lots of important post-ownership agreements to consider too. One thing we do want to touch on too is what we typically see, what we recommend most often is that any purchase of a practice be an asset deal, where you're just buying the assets of the existing practice and then dropping them into your new corporate structure, whatever that might be. From a buyer's perspective, we caution pretty strongly against buying the corporate stock or the corporate LLC that already exists there. Lots of sellers might want to try and sell you that common stock of the corporation or sell you the partnership or the LLC that owns the practice. And that really relates back to a price allocation issue. Remember, as the seller, they want to get as much treated as a capital gain as possible. If they sell you the corporate stock, 100% of the purchase price is as a capital gain, which is great for the seller, but is really probably a pretty bad deal for you as a buyer. For one thing, it raises the acquisition cost pretty considerably for you, and it raises it by as much as 40%. And the reason for that is if you buy corporate stock, you don't get any tax deduction for that until you sell the stock at some point in the future when you're ready to transition out of the practice. So all those tax deductions get delayed. So you've got to make $1 income in the practice, pay tax on it to have 70 or 60 cents left over to pay that bank loan off. So it gets pretty expensive as a buyer. And then also, the other issue we have is if you buy the corporation, you're now the new owner of that corporation, and anything that went wrong in the past, any sins of the past, are now your problem as the buyer to deal with. So anything bad that could have happened, that might have happened, could come back on you. So we always suggest as the buyer, only do an asset purchase. If the seller says, I'm only going to sell stock, unless it's the perfect practice, and you're willing to do a lot of due diligence with your attorney, it's probably time to consider, or at least think strongly about walking away from that specific deal. Finally, I think the other big thing we always advise everybody to think about is you really need a team in place to help with this. And it shouldn't just be you as the vet trying to go out there and handle all this, but I think you need a team. You need your attorney involved to either help you draft the documents you're going to need or to review all the documents that the seller's drafting. I think you want your accountant, your CPA involved to really help you work through what is that tax allocation, how's it going to impact me as the buyer. And then you need your lender involved too. Unless you've got a bunch of cash sitting around at home, you're probably going to need to go to the bank to finance some of this. So you want your lender involved as soon as you can so that they can get comfortable with the deal and the structure and help you through that process. So with that, I'd like to open it up to any questions that anybody might have on this. We've got a couple already that we'll start with, but if you've got any, please submit those so we can get to your questions too. Laura, since I've been talking last, I'm going to make you answer the first question here. One of the questions, as a new buyer for buying an existing practice, do we have to buy the accounts receivable from the seller? Is that a requirement or something we'd have to do as a buyer?
No, it is not a requirement. There may be a reason why you do or do not want the accounts receivable to purchase from the seller. Typically, when I'm advising clients on whether or not to buy AR, we do a couple things. We will look through I'll request a detailed accounts receivable aging schedule and review it, making sure that it looks like it's all current accounts receivable for more current services versus, people who have been in debt to the practice, if you will, for 6 months, 12 months. It's pretty easy to identify who is paying on the bills and who not when you are looking through the details of the accounts receivable ledger. But sometimes it's helpful to buy the accounts receivable from the seller when you are looking at buying a practice, because sometimes it helps boost cash flow in those early months because you're collecting on the receivables that were in existence from there. But more often than not, I see the seller keep the accounts receivable, the new owner continue to collect on it, but transition that payment over to the seller as the receipts are collected over the last couple months.
The other interesting question we have right now is, do you have to buy the entire practice? And that's a great question and brings up some interesting scenarios. And I think what we typically see is most people would buy the entire practice and would take the whole thing over from the seller and roll forward with their new practice. But it doesn't have to be like that. And I think where we most typically see it not be structured the same is if you're looking at a mixed animal practice and you're only interested in the large animal side or the small animal side. There have been a couple transactions we've seen where that existing practice has gotten split into two new practices, and we've had a buyer come in and only buy the small animal side or only buy the large animal side, depending on what their interests were or what their preference was. So it doesn't necessarily have to be that you buy the entire practice, or the practice might come with a big boarding practice, a big grooming practice as a part of it, and you might not be interested in those pieces. So you wouldn't necessarily have to buy all of those. The challenge would be there is, as we're looking at financial records and tax returns, is trying to take that one set of financial statements for the existing practice and split it into what does the large animal piece look like now, or what does the small animal piece look like now, and how do we figure out what equipment goes with one practice or the other, or what supplies go with one or the other, or how we figure out of the total goodwill of this total practice, how do we split it into the goodwill attributable to the small animal practice or the large animal practice. So it can be done, but it presents some unique challenges as you work through this due diligence process, the negotiation process, and I think really speaks back to our idea of having your team ready and set up and experienced with these kinds of things so they can help you through that and help give you some good advice on that.
Did we have any other questions?
No, those were the questions that we had. Again, if anybody has any questions that they think of in the future, Matt and Laura's contact information is on the screen. Feel free to reach out to them and they can help you out. So thank you, Matt, thank you, Laura, and thank you all for attending. I hope you have a wonderful day.